another topic, Ryan. We're about halfway through, so I think that means time for your listicle, which is this week about share cannibals. So why don't you go to that segment?
Sure. So I was looking at some share cannibals, which the way I'm just defining that is companies that have bought back a lot of their stock over a sustained period of time. You can kind of quantify it however you want. I did companies that bought back more than 5% of their stock annually over the last decade, which it's hard to do that if you're a company that grows quickly because you're probably going to get a premium valuation. So it's difficult. You basically have to be valued quite cheaply in order to buy back more than 5% of your stock every year. But only 46 companies in the United States have bought back more than 5% of their stock each year over the last decade. Interestingly, most of these have underperformed the market.
Wow.
I guess that kind of makes sense because a lot of these companies are kind of at the stage where there may be low to no growth and they don't know what to do with the cash flow that they have. So they just buy back stock.
And there's been a lot of multiple expansion driving the broader market.
That as well. But there are some gems in here as well that have been misvalued, I would argue. And they've been able to both grow and buy back stock over the last 10 years. And so I'm going to go through 10 of them. These are the best performing ones. So the number one best performing share cannibal is Murphy USA, the gas station operator. Primarily operate throughout the Southeast, Southwest, and Midwest, I believe, because they don't have any up here in the Pacific Northwest. But yeah, they have compounded their total return performance. They're up 25% a year over the last 10 years. I can pull up the more specific numbers actually to get down to it. But yeah, they were the best performing stock by quite a lot. The second highest performer is Louisiana Pacific. I'll say this is a company I had never heard of prior to seeing them in the screener. They sell building products for new home construction, repairs, remodels, stuff like that. They have reduced share count by 48% over the last decade, and their total return is 578%. So pretty solid. I'm not going to go through all the numbers. I think I'll speed this up a little bit. But third best performer is Pulte Group. It's a home builder. Fourth, O'Reilly Automotive. Fifth, Lowe's. This is an interesting one because the sixth one here is AutoZone. So O'Reilly and AutoZone have both been valued very similarly. And they've both been able to buy back a lot of stock. They've had the same tailwinds to some extent. They've had the same tailwinds where cars on the road continue to grow. The average age of cars on the road continues to rise as well. So it's just overall increases in serviceable customers. But Lowe's, who you would think is benefiting from a lot of the same tailwinds as Home Depot, they have not grown the business quite as quickly largely because Home Depot has done so well optimizing their existing stores and also catering to pros. But they've been able to generate similar, if not better, returns purely because they're valued at a discount to what Home Depot is valued at. So their buyback has been really incredible. So yeah, they've been the fifth best performer here. AutoZone 6, 7, Ameriprise Financial. 8 is Dillard's. This is an interesting one because it's one where I would not own the business if it were trading at like 15 times earnings.
Yeah,
It's
you hear
retail
that,
department stores.
Unownable. That's what I think. But it's done well,
Yeah.
right? Because they essentially went up like 600% because they just bought back so much. It was so cheap.
Yeah. It was, and I'm not sure what exactly happened here, but so in 2019, they were doing about $6 per share in earnings. And over the last 10 years, they've bought back 66% of their stock, which is one of the fastest pace buybacks I've seen, other than maybe AutoNation might have done more. So $6 in earnings per share in 2019. 2022, $42 in earnings per share. I guarantee you that is not because this is a rapidly growing business. They sell fashion apparel, accessories. It's big retail department stores. It's not a glamorous business, not hyper growth, but it's a good example of a management team with a good head on their shoulders being rational about the way they allocate capital, and they've done a good job. And they've actually been able to just operate okay. I would have thought they'd been crushed, but they've done all right.
Yeah, they're
Number
pricing
nine.
in. Oh, yeah. Sorry. Yeah,
No,
the rest of the list.
yeah, let me just finish up here. Number nine, Group One Automotive. They own automotive dealerships, franchises, and collision centers throughout the US and the UK. Actually, pretty intriguing business, honestly. Earnings per share have grown at 24% annually, trades at an EV to EBIT of 8 times. So, kind
Wow.
of intriguing there. Similar, it's kind of in a similar boat to AutoNation, where you operate these dealerships and there's some ebb and flow with the auto market generally. So, maybe it's kind of potentially a cyclical here. Then the last one is Credit Acceptance Corp. They just provide financing programs to auto dealers in the US. I guess I'll let you kind of give your thoughts here, and then I'll give, I don't know, some of my takeaways looking at this list.
Yeah, so I while you were talking, I pulled up Murphy USA here on FinChat. I'll share the screen here in a minute, but I will say if you want to use any of these cool screeners, you can actually do it for international stuff as well. All these different sectors. It's a really, really robust screener now. You can go over to finchat.io/chitchat, get 15% off any paid plan. We love using them. It's a wonderful product, and they improve all the time. We just added median, or not we, Ryan works there, but they just added median, min, and max on the charting, which can be quite interesting, I think, to help visualize whether a stock's trading at a premium valuation. I mean, for example, we talked NVIDIA today. You could check that out in the past, valuing cyclicals, all that stuff. I mean, you could even do a screener with stuff over at, Japan, Korea, even something even smaller like Thailand. I mean, they're building it out even better every day. So finchat.io/chitchat. But let me share the screen here. I have shares outstanding at Murphy USA along with earnings per share growth. Let me pull it up to get the exact numbers here, but I'll read them out. So we got shares outstanding declining at a very consistent rate, 8.2% per year since December 2014. But what's interesting is that earnings per share really didn't go anywhere from 2014 to 2019. They actually went down slightly. And then during the pandemic, they've boomed and now stabilized over the last couple of years. What would you think seeing this chart, Ryan? Would that scare you or not? Because it feels like maybe the pandemic helped them a ton, or maybe I would just have to investigate what was going on in kind of 2017, 2019 range, because maybe they're reinvesting or something, and they all that bared fruit over the last few years. But something that I wouldn't be concerned about, but I would need to know why earnings per share growth has been so sporadic.
If I remember correctly, I, I believe Murphy is one of the gas stations that actually earns a decent spread on the gas prices, as opposed to uh, a lot of convenience stores. They'll sell the gas essentially at cost, and then they'll make money on the goods in store, selling food and stuff like that. I believe Murphy earns a good spread on the gas, so the fuel revenue. And I think gas prices shot up during that time period, if I'm not mistaken. So that might have had an impact as well. I would have thought though they'd keep their spread similar, so I don't know how much it would impact earnings per share, but might have had
Yeah, it's
some
a good
impact.
point. Yeah. So I still think it's an interesting chart though, and seeing an 8% per year decline is quite good. I usually like to see, like I get excited when I see 3% per year over an extended time period. But if you do 8% decline for 10 year, I mean that can be quite good. Let's see. Tyler asks, what companies do you think will be on this list in 10 years? What do you think, Brian?
My bet is there will be a good amount of home builders on this list. There's a good amount of home builders already on the list, but if we zoom 10 years out and you think that the supply and demand balance for home builders in the US is okay, a lot of them trade really cheaply right now. So I would suspect they're going to be able to buy back. Where I think you get leaders in share cannibals, where companies that really reduce stock by a lot, is when there's like a common narrative that doesn't hold true. So like AutoZone and O'Reilly, electric vehicles are going to eat up a lot of the market share for O'Reilly and AutoZone, or a lot of the potential customers. They're not going to be able to sell as much products. That just really hasn't held true. The number of internal combustion engine vehicles on the road has continued to grow, and it's just basically been this tailwind for them, where that narrative has let the stock be cheap, but they've continued to generate cash and be smart about how they allocate it. So cars on the road, that kind of is one that's maybe a false narrative. Potentially, if you believe that home builders aren't going to be able to sell as many homes, or they're going to, there's going to be this big downturn in the real estate market in general. If that's the narrative out there, which it seems to be the narrative, that real estate's going to struggle because of the multiples that we're seeing on a lot of home builders, if that's false, I imagine they're going to be pretty high on this list in 10 years.
Yeah, I agree. That makes sense. Someone here said Ulta Beauty. They buy back stock and the stock's gotten cheaper. So, hey, if it keeps being perennially cheap, it could stay there. We have a comment that says boring, out of favor, and good at capital allocation. That's what he's saying with all these companies. I think that's true. When looking at that list, one of my takeaways is you have to be in an industry that's not sexy. And as you mentioned, the other tenant there as well that I agree with, where you have stuff that no one is really getting excited about. It's not going to be in the homepage of the Motley Fool with the top trending article writing about these companies. So I I guess you'd have to look at something that people are too bored about. Someone mentioned tobacco, but they pay too much in dividends. But that can make sense if they were buying back all that stock there, right? Because the narrative is that the profits are going to go away, and if they don't, if they bought back a lot of stock, that would help. I think another one, people talk about the energy sector. I don't know how it's a little cyclical for me, but I don't know. Maybe there's some stuff with stable earnings. Who knows? Don't know about it that much. But yeah, what do you think?
The other thing that seems to be a trend here, at least when you look at like Murphy, O'Reilly, AutoZone, Polta Group, Lowe's, these are businesses where their size has afforded them the ability to take share, because they can sell goods at a lower cost, or reinvest some of those margins back into being a better provider for customers. Like O'Reilly, for example, they've stolen a lot of share from kind of your mom and pop auto parts stores. Lowe's, certainly, if you've got like a home improvement type of retail location, I bet it's real hard to compete with Lowe's and Home Depot come into your market, because they get such lower rates from suppliers. It's just companies that have also gained share. Even though it's a slow growing industry, all of those, the share growth has allowed them to also kind of grow revenue at a quicker pace.
Right. And I think what's dangerous and counterintuitive is if something starts randomly growing 20% revenue growth. For example, we talked about Elf Beauty or Hims and Hers, which we actually have a question on Hims and Hers. I don't think we could answer because I don't know the answer to it. But, if something starts accelerating revenue a ton, that multiple is going to expand. But if you keep revenue growing at 5% for 10 years and the earnings multiple is below 10 and you buy back stock, hey, that's a great recipe for 15%, 20% compounded returns. Someone mentioned coal here as well on the chat. We got a lot of people saying they enjoy the interactivity with the chat, so we'll keep doing that. I think if more people start joining, it'll be harder. I don't want to get to that point where it just starts scrolling and you can't even read anything, but I guess that's a good problem to have. But let's move on to the next topic. And Ryan, do you want to talk about our friends at Public again, and then go to your small cap of the week?